Nvidia CEO Jensen Huang just stood before a packed audience at the GTC conference and projected $1 trillion in purchase orders for his company's latest AI systems through 2027. This demand is fueled by the rise of agentic AI. Unlike simple chatbots, these applications spawn autonomous agents to handle complex tasks, a process that generates a massive volume of data tokens and requires an exponential increase in processing speed. But this hardware boom has a high entry price for the rest of the industry. Meta, for example, is reportedly preparing to lay off more than 20% of its workforce to help offset the tens of billions it is spending on this exact infrastructure. The speed of this spending is worrying some of the most seasoned investors in Silicon Valley. Benchmark partner Bill Gurley recently warned that the current rush to get rich quick is creating a bubble that will lead to a violent economic reset. We are witnessing a direct mechanical link between these two worlds. The wealth accumulating at the silicon level is being extracted from the job security and budgets of the everyday workforce. Mapping this capital cascade from microchips to the inbox provides a blueprint for the structural pressures that will define the coming market recalibration. The foundation of this boom is the Vera Rubin system. These server racks contain 1.3 million individual components and deliver 10 times the performance per watt of the previous generation, a critical metric as energy consumption becomes the primary constraint on AI growth. To clear data bottlenecks, these racks utilize the Grok 3 LPU, or Language Processing Unit. This is a specialized chip designed to handle the massive memory requirements of agentic workflows at much lower latency than a standard processor. This massive physical build-out acts like a financial vacuum, pulling unprecedented amounts of available tech capital away from other sectors to pay for the sheer scale of the hardware. This hardware layer functions as the primary filter for tech finance, determining which companies receive investment and which are left to compete for what remains. That vacuum is already causing collateral damage in corporate finance. Apollo executive John Zito recently told clients that the valuations private equity firms currently claim for their software companies are broadly incorrect. This chart shows a widening gap. While hardware values soar, the market is punishing legacy SaaS companies, fearing replacement by autonomous AI. Zito warned lenders to these legacy firms could recover as little as 20 to 40 cents on the dollar. This happens because companies are cannibalizing their own budgets. To afford the multi-million-dollar Nvidia systems they need for the future, they are slashing their spending on the software tools that defined the last decade. The AI boom is a zero-sum game of capital reallocation. Growth at the top is paid for by the active destruction of the previous software economy. This split screen shows the disconnect as it reaches the office. While 83% of HR decision-makers believe AI tools make workers faster, 67% of those same employees report that the technology is creating new friction and mistrust. Much of that mistrust stems from a phenomenon known as Workslop. This is AI-generated content that looks polished and professional on the surface, but lacks any actual substance, nuance, or human judgment. Data from BetterUp Labs shows that 53% of workers have already submitted this Workslop. This shifts the burden of editing and critical thinking onto colleagues, who now must sift through an endless pile of content with less meaning. This trend drives anxiety at the ground level, with 61% of employees now worried about bias, misinformation, and the eventual obsolescence of their roles. Currently, agentic AI is optimized for the volume of work rather than the quality of it. This degrades the collaboration between teams and erodes the baseline of trust required for human work. The full cascade is now visible. Trillions flow into silicon, budgets drain out of legacy software, and the result is a flood of low-quality workslop hitting the end user's desk. This reset signals the moment the market recalibrates. It marks the shift from a period of speculative hardware accumulation to one where the market punishes companies that bought the silicon but failed to build a functional, productive business around it. Simply buying chips and cutting staff is a strategy with an expiration date. The winners of this reset will be the organizations that focus on change management, upskilling their people to manage and refine AI output, rather than just generating more of it. For the individual, the most valuable skills are shifting. In a world saturated with automated content, human editing, critical judgment, and strategic thought are becoming the rarest and most expensive commodities. The hardware for the next decade is already in place. Now, the economy and the humans within it must adapt to the reality of the silicon they've already paid for.